Right, everyone, welcome. Welcome to our investor education series. We're going to be talking about what is a cap rate and why it's important as a passive investor. So I'm your host, Camilla Jeffs. I'm CEO of SteadyStream Investments, and just a little bit about our company. We help you build wealth by investing passively in multifamily group investments. And we're really here to help you figure this all out, specialize in teaching the first-time passive investor how to invest and really diversify your portfolio and add real estate to your portfolio if you don't have it already. So today, again, this format is 20 minutes of me teaching and then followed by 10 minutes of Q&A. So if you're joining me live, please drop your questions in the chat box and I can answer them at the end. Also, I always am curious to, I'd like to make sure these are super informative and helpful. So if there's a different topic that you would like to learn more about, feel free to throw that in the chat as well. And I can use those ideas for the next one. So today we're going to learn about what is a cap rate. What is that even? When I started out investing, I spent, my first 15 years investing in real estate, and I was all in single family and small multifamily, and I never even heard of a cap rate. I never even used a cap rate. I didn't understand it. So when I shifted into large multifamily and commercial real estate, all of a sudden cap rate was all the rage and you had to understand it. And so it took some time for me to figure it out. So I'm going to try and simplify it for you today to really understand exactly what is a cap rate. Then we're going to work on how to calculate the cap rate, right? Because it's a formula. So get your math brains on and we're going to work this out. And then we're going to try and figure out what to look for as a passive investor. Because as a passive investor, cap rates are important. And we're going to go through why and what you want to look for when you're evaluating a deal to invest in. Okay, first let's talk about what even is a cap rate, right? Like I said, been involved in real estate for a long time, and you learn new terms and the jargon, right? Cap rate is short for capitalization rate. And it's a really important term. So basically, it's like a snapshot in time of a commercial real estate asset's return. So as we're looking at cap rate, so let's talk about kind of what makes a good cap rate. It's a number, right? It's a number, and it's typically a percent. So cap rate would be anywhere from 1% to 10 to 12%. And we rarely see 10 or 12% cap rates these days, especially in large multifamily, but typically it's a percentage. So let's talk about what's a good cap rate and what a safe cap rate is. So basically, a safe cap rate is where investors only take on as much risk as you're comfortable. So in cap rates, a lower cap rate implies lower risk. Okay, keep that in mind. Cap rates also have an inverse relationship to price. So visualize in your mind a seesaw, or I called it a teeter-totter when I was growing up. Teeter-totter, seesaw, right? You have one kid on each end, and then one goes down, the other goes up, and then they reverse, right? So with a cap rate, if the cap rate goes down, that means the price of that property goes up. If the cap rate goes up, the price of the property goes down. So that's how a cap rate works in relationship to the price. Now, location has a really big effect on a property's cap rate. So think about markets that are in really high demand, or that have really high prices. So markets in California, for example, or New York, they have really high prices. They also have higher potential income, right? So if you buy a property in New York, you can typically rent it out for much higher than you could in, say, Nevada, right? So there's all those differences to keep in account. So markets with really high demand are going to have higher prices, higher income. And so remember, higher prices means lower cap rate. So the cap rate is going to be really low. But once the market kind of shows signs of cooling, so markets fluctuate, right? Markets go up and they go down, and they kind of have different ways of going around. So once it shows signs of cooling, rents kind of take a dip, then cap rate is going to rise, meaning the value of your property could be going down, right? So that's what we talk about when we're talking about a good cap rate, safe cap rates, right? So the higher the cap rate, so if there's a property that's being advertised at a 10% cap rate, for example, that's going to mean there's more risk. And more risk could be things like, well, the property is only occupied at 30%. And so now we have a lot of work to do to get that property occupied up to 80 to 90%. And it's a riskier investment. So keep that in mind. All right. So here's some things to consider, right? So when you're looking at cap rate, does the cap rate reflect the risk you're willing to take? So what's your own risk? Take a look at yourself. Think about what kind of risks are you willing to take? Are you in a time of your life where you can take bigger risks? And remember, bigger risks often mean higher rewards, right? But they also could mean really bad things can happen. So think about your risk, right? Are you in a position in life where you can take big risks, or are you in a position in life where you're like, yeah, I'm not that willing to take very much risk. I'd rather have something more stable, right? And so that will help you determine what a good cap rate is for an investment that you're looking at. The next thing to consider is time, right? So over time, the markets change, and therefore so do the cap rates. Phoenix, Arizona. Let's talk about Phoenix, Arizona for a minute. Phoenix, Arizona, in 20 years from now, the cap rates were probably around 8 to 10%. Today, those cap rates are 2 to 3% because the conditions have changed there. And they've changed such that a lot of more businesses are moving in, providing many more jobs, huge population growth, which causes the value of that market to rise and therefore cap rates to lower. So one of the things that you can look at is market forecast. Is the forecast for that market one that it will continue to grow, right? Or is it one that it will not grow? So Phoenix, Arizona, for example, I was looking at a market forecast, and it shows that by 2030, there will be 720,000 new jobs that have entered that market. So by 2030. So that tells us, okay, that's a great place to invest because it's still growing and it's still going to, and of course, a growing market means people need places to live. And so that's what we can do as real estate investors, is we provide those places to live. Okay, location plays a huge role in impacting the cap rate, and even within an area, right? So we say Phoenix, but Phoenix is a small city, but then there's secondary markets around that, and then also tertiary markets. So think of Phoenix in the middle, and then if you go further away from Phoenix, it's not as hot, right? So the cap rates will probably rise the further away you get from the city center. And that's typical in most large markets. High demand is going to equal that low cap rate. Then the other thing to consider is the asset type. So if you're buying a Class A, Class A is like a brand new construction, has all the bells and whistles, really cool amenities, has a butler, all those fun things. That will be a much lower cap rate than, say, a Class C asset, which is your older. They're typically built in the 70s or 80s. They need a lot of renovation. The buildings are just getting old, and so there's more risk associated with that. And therefore, the cap rates will be higher. So even though, the Phoenix market has a general cap rate, within the asset types, there's going to be different cap rates as well. Okay, so let's talk about how to calculate it, right? It might sound intimidating, but it's actually really easy. Don't stress about it. So you just need two things to be able to calculate it, right? So you need the property's net operating income. Now, if you're not familiar with financial statements, don't worry. It just simply means what's all the money coming in, right? Your revenue, that's the fancy word for it. All the money coming in. So like the rent, how much rent are you collecting? Is there money from laundry? Maybe you have a laundry facility on site and you get paid for that. Is there money coming in from reserved parking spots, or are there storage units? Whatever income is happening in the property, it goes in that revenue line. And then you need to figure out what are the expenses. So all the expenses that the property has, then you will subtract out those expenses. But remember, the expenses, that's before you pay the mortgage. Mortgage is not considered an expense in a commercial property's P&L. That's considered your debt payment. So all of your income minus all the expenses, except for the mortgage payment, equals your net operating income, or NOI. So you take that NOI and you're going to divide it by the market value of the property, right? So you take you get the market value of the property, and typically it's like the sales price. So if you're looking at an apartment complex, whatever the seller is trying to sell it for, you find the NOI, divide it by that sales price, and that will equal your cap rate. So let's do an example. It's much easier to learn this by example. So let's say a property costs $1 million to purchase, right? And it grosses $100,000 through your rent, and then it has total expenses of $30,000. So $100,000 minus $30,000 gives us an NOI, net operating income, of $70,000. So now to calculate that, we're going to take the $70,000 and we're going to divide it by the purchase price of $1 million, and that gives us a 7% cap rate. Now, is that a good cap rate or is that a bad cap rate? Well, depends, right? Depends on the area, it depends on the time, depends on the asset class. So there's a lot of different things that it can depend on for the cap rate. So now let's talk about, what does this really mean as a passive investor? So if I'm a passive investor and I'm not someone who wants to really deal with all the financials and I just want a safe investment, right? So you're going to look for two things here, right? Number one, what's the cap rate at the time of purchase? So you get the investment summary from the operators, and it will tell you what the cap rate is. It tells you the purchase price. It'll tell you what the current net operating income is, and then it will tell you that cap rate. So if the cap rate is if they're buying at a cap rate of, say, 3.5%, which is very common, especially in the Phoenix market, then now you know that 3.5. So what are the clues? What does that tell you? Well, it tells you actually a lower risk investment, right? So remember, low cap rate equals lower risk. It also tells you that the price of that property is kind of high. Remember, the lower the cap rate, the higher the price of the property. So it's kind of high. So maybe that's a problem. I'm not quite sure yet. But that cap rate can tell you, but the risk is low. So that's good. That I like that there's low risk there. If I'm the type of investor who's looking for a low risk one, right? If you can handle higher risk and you want higher reward, then you could go for a higher cap rate. Okay. So now you know what the cap rates tell you. Then the second thing, and this one's really important, is you need to know what the assumed cap rate is at the time of sale. So every operator goes through and they put together a financial projection. And one of the biggest things about that financial projection is they are projecting what they think the property will be worth in 5 years when they sell it. Now, how do they figure that out? That's probably another webinar, but just quickly, one of the things that they do is they figure out, well, how much value can we add to this property? Could we increase the rents? Could we go and do some renovations? Could we decrease the expenses? And then they say, and then over time, if we hold it for about 5 years, the rent is going to increase naturally about 2 to 3% per year is what we're projecting. And so we think that by the end of 5 years, so say you bought the property for $5 million, we think it's going to be worth $9 million at the end of 5 years because of the things that we do to it. So, but that is also based on the net operating income and what we assume the cap rate will be at the time of sale. So remember earlier I talked about markets are cyclical. They kind of go up and down and they move, right? The cap rate is a moving thing. That's why it's just a snapshot in time of what of the property's value. So if today we bought it at a 3% cap, in the lingo, they just say 3 cap. So if you hear that, that's what that means. 3 cap is a percent, right? So what's the assumed cap rate? So if we bought it at 3% today, one thing that you really want to look for is that they are projecting a higher cap rate at the sale. Now, Why would they do that? That means the property will be worth less. So I thought you were trying to make the property worth more. Yes, we are trying to make the property worth more, and it will be worth more based on the amount of income that we generate out of that, because we're going to work really hard to increase the income. But there should be a healthy difference in that. If there's a difference at least 0.5 higher, right? So if you bought it at a 3% cap, you want to see at least 3.5. These days in this market right now, in early 2022, we probably want to see at 1 to 1.5 higher than the cap rate at purchase. So we want to see that they're valuing it at like a 4.5% cap instead of a 3% cap. And that tells me something. What that tells me is that over the course of time, even if the value of the property, right, the value of that market goes down, right, because markets could go down, that we still could achieve a good return for investors. And so that's what we're trying to look for. What we don't want to see is we don't want to see someone who is valuing it at the exact same cap rate today as it will be in 5 years, because we anticipate what has happened in this COVID environment is it's been great for real estate investors, and it's still great that we actually are, a lot of us are thinking that cap rates will decompress, meaning they will start to rise, right? And so you don't want to be caught in a situation where you bought a property and you think it's going to be worth so much in 5 years, and now all of a sudden it's not. And so to conservatively project that, you want to have that healthy difference in those cap rates. So that's all the information about cap rates. And if you have questions, please put it in the chat. But if you want to learn more, you'll feel free to sign up for my newsletter. I have a free masterclass called Passive Investing Made Easy. It's a series of videos, a really perfect place to start. It gives you all the information from A to Z. And then I have lots of toolkits that you can grab at my website, CamillaJeffs.com. So now I'm going to check the chat and see if there's any questions in the chat. Perfect. I got one. It says, how would you vet a syndicator and a project you're looking at? So thanks so much for that question. There's lots of ways to do that. So I'll give you a quick overview, but then I did do a webinar on this. So you can run to my YouTube channel and you can find that, how to vet an operator and how to vet a deal. So to vet an operator, one of the things that you're looking for, one of the biggest things you're looking for is track record. So you're looking for someone who's been there, done that, and has been doing it for a while and has had some really good success. So you want them to, you basically, you don't want to invest with a whole team of newbies. Now, in the commercial real estate world, there's a lot, we partner together, right? So I'm part of Steady Stream Investments, and I would partner with adventurous real estate investors, for example, and then other people would come in and partner. And sometimes, though, they're new people, right? It's not that we don't allow new people in as active investors, but we want to make sure that the lead sponsor knows what they're doing. And so that's what I would look for in a syndicator. And then the project you're looking at, I mean, it kind of depends on your goals. Really, you got to understand yourself as an investor and what are your goals. So if you're looking for a project that provides really good cash flow, then you want to take that into account, and you want to say, okay, well, how much cash flow is coming in year 1, in year 2, year 3, year 4? Because some of the deals, especially value add deals, may not have good cash flow in the first year or 2. So when you're looking at a project, you want to kind of understand, am I investing for cash flow or am I investing for appreciation? Other things you want to look at in projects is the business plan. That's probably one of the number one risks to investing as a passive investor, is the business plan. And what is that? Well, often the business plan is we're going to go in and renovate the units and then increase the rents. But is that feasible, right? And can they do it? And how long are they saying it would take them to do it? So here's a red flag. If someone says, oh, my business plan is going to go in and we're going to renovate all the units, and it's 200 units, we're going to renovate all 200 and we're going to do it all in 9 months. That's a red flag, because condensing it down to 9 months means you're going to take the occupancy down very far to be able to do that, because you're going to have to take a lot of units offline at one time to do it. So that means the income is going to be a little bit precarious, and you don't want to ever take it down to income that would be a struggle. So thanks for that question. Again, jump to my YouTube channel and there's more explanation in there. Okay, another question says, what area or locations do you like for 2022? That's a great question. So, where am I investing? So, in 2022, I am definitely investing in Phoenix, Arizona right now. It's such a strong market. There's so many people that are moving in. Just jobs are huge companies and tech companies are coming in and announcing lots of job opportunities. And the supply and demand is so off right now that it's a really great opportunity to get into right now. So 2022, definitely Phoenix, Arizona. Another location that I really like for 2022 is Oklahoma. And in Oklahoma, it's such a strong, steady cash flowing area. It's not as explosive in growth as your Phoenix, Arizona, but it has strong growth that is coming in. And again, supply and demand is off. There's just not enough supply for the demand for housing in that area. So I really like that. And the other location that I like is Texas. Texas is very similar to the Phoenix market, just huge growth opportunities and things for those. So those are areas that I'm looking to invest in personally this in 2022. Okay, so there's another one. It says, what are the typical fees for the syndicator? So, the syndicator, it's group investing, right? So that we come together as a group. You have passive investors and you have the active investors. Passive investors invest their money, and then active investors invest their time and energy and things like that. So, what are those fees? Like, how do the active investors get paid? Well, they get paid a couple of ways. So, way number one is through an acquisition fee. This is very similar to what you would pay if you're purchasing a home from a realtor, right? So it's like it's a fee for putting together the transaction. It's a fee for going out and finding the deal, for vetting the deal, for negotiating, for doing all the due diligence and making sure that it's going to be solid, for getting the lending on it and doing things like that. So there's typically an acquisition fee that ranges anywhere from 1% to 3% of the purchase price. The second way active investors get paid is through an asset management fee. And so as active investors, we are managing the property manager. And so we're trying to make sure that the decisions get made, such as, no, we're not going to renovate all 200 units in 9 months. That's a bad idea. So let's make a pivot and change, and let's do things the right way here. The asset management fee is again 1% to 3%, and that one is of revenue. It comes from the revenue. And then finally, as general partners, we share in the profits with you as passive investors. And so, sometimes that'll be a 70-30 split, 70% going to passive investors, 30% to active investors. Sometimes it's 60-40, 50-50, 80-20, just depends on the deal and how it's structured. Okay, so and then I have another question that says, how do I get more details? So they want to know about minimum and maximum investments we're accepting for Arizona and Texas. So typical minimum is 50,000, and maximum would probably be right around $1 million for these deals. And so as we're going through, so if you would like to get more details, I'm going to post I'll post a link here. And you can join my investor crew. So to join the investor crew, you can go to that link and just sign up. There's a form that you can sign up for. And then you'll need to schedule a call with me, because most of the deals that I do, we have to have a call first before you can have access to them. So feel free to go ahead and do that.